Hi, my name's Matt Johnson, one of the fixed interest portfolio managers here at GoalsGetter by Nikko AM. Today, the Reserve Bank kept the OCR on hold at 5.5%. And whilst this no decision change was widely expected, the somewhat dovish tone of their statement was a surprise. Going into the meeting, markets were focused on just how hawkish the RB could be, with concerns that they could deliver a very strongly worded statement that could suggest that further tightening is needed. These concerns stem from the Reserve Bank's November statement, where they indicated that inflation was not falling fast enough and that they had a low tolerance for any increase in time to return to target. This concept grew further in strength when the Reserve Bank's head economist made a speech back in January that downplayed the recent weak economic data whilst highlighting sticky domestic inflation. All this aside, I was pleased with the Reserve Bank's decision today, which further increases my conviction that the OCR is unlikely to rise from here. There were three key points in the monetary policy statement today. The first was that inflation is more balanced in terms of its risk, as opposed to the Reserve Bank's November statement where they were really concerned that inflation wasn't coming down quick enough. The second is that monetary policy is restrictive and is having a real impact on demand and the economy. And the third is that growth is weak both domestically and with our key trading partners globally. All in all, I agree with these themes. In fact, when it comes to the economic data, it's quite hard to find a positive story. We can look at economic growth, which has turned negative. We can look at retail spending excluding inflation, which has been negative for the last 8 quarters and is down some 7% on a per capita basis over the last year. We can look at the labour market, where we see unemployment is increasing and the number of applicants per job ad is increasing. In general, there's more labour availability thanks to both strong net migration and increasing unemployment. We also have the government asking its departments to cut spending by between 6.5% and 7.5%. We can look at the housing market and building activity, where we see building consents are down around about 1/3 from their pre-COVID peak, and housing prices have not really taken off over summertime. Finally, it's important to remember that monetary policy works with a lag of around 18 months to its maximum impact. And here we should remember that the OCR was last increased some 9 months ago. So there are still growing impacts from past decisions that are yet to fully come through. A key data point that I like to look at here is the average level of mortgage rates outstanding across all mortgages versus where you could refix a mortgage today. In the most recent data, as of December 2023, the average mortgage rate was 5.9%, whilst if you were to walk into your bank today, you would be looking at a rate in the low 7s or high 6s if you were borrowing 1 or 2 years in term. Ultimately, as to what this all means, it means that it is unlikely that the OCR is going to rise further, that interest rates will fall in the future, but some patience is needed. Perhaps they will fall towards the end of 2024.